Before we move on to our audit expectations for the 2013 and 14 year, I thought we'd go back to last year's reported auditor results to put things into perspective. So we report on the timeliness and the quality of the annual financial statements. You can see from these results that 100% of all government departments met their 31 August statutory deadline. So that's an excellent result, particularly in light of some of the challenges you've had with your financial resources and staffing during the year. Statutory bodies are less so, but that raw data there includes water boards. Now, for a number of very good reasons, the remote and regional water boards are our audit problem children. So if we take those away from that statistic, about 93% of statutory bodies actually make the 31 August deadline, which is another very good result. So now that timeliness is less of an issue, we want to focus on the continual improvement to the quality of the financial statements. And that's not just the quality of the final product, the financial statements, but the quality of the internal controls and management judgments and oversight that gets to that final product. So the first process that underpins financial resource management is the CFO certification. The Chief Executive has delegated this financial resource management to the CFO, and the aim, or the purpose, which is a low likelihood of material misstatement in the financial statements, aligns with our audit objective. And because of this, we consider the CFO certification as audit evidence, and we seek to test and rely on it. We found that most departments had a very good process in place when we reviewed them last year, but I'm sure you're aware that auditors are only ever happy when we see continuous improvement. So we do have some areas for improvement. One area is the planning and documentation of the process, and that starts from the internal controls framework, then to the financial risk assessments and the mitigation activity associated with those risks, through to defining what needs to be reported and the interactions that you have with those charged with governance. During last year's audit, QAO determined that the Department of Education, Training and Employment had a very good process in place. And the next speaker, Adam Black, the CFO, will run through this process with you. But we do have to audit that process, as I said before. So there are some areas where we seek to see audit evidence. I've got them listed up here. And to give you an example, we'll take the financial reporting risks. We need to see your financial reporting risk register. We need to see that it actually aligns to what we perceive to be your financial risks. And we'll look to make sure that actions are assigned and follow-up is taken place to make sure that there is appropriate risk mitigation, and so you have a low residual risk, and that adheres with your risk appetite. To do that, we will review things like the detailed and dashboard month-end reporting, making sure it goes up to the right line management, to the right executive management, that the data that's being reported is reasonably accurate and all the red flags are being identified. We'll look at the depth of discussion that goes on around these reports. All these things help manage risk. And where applicable, if you have breaches and incident reports, we'll look at those and we'll look at the follow-up on them. We next look at your month-end and year-end accounting processes. So accurate month-end accounting not only reduces the year-end workload and contributes to a smooth audit process, but it makes sure that your most senior management are making decisions that's based on the most accurate available financial data. New South Wales Treasury has put out a best practice guide, and I recommend it as a very useful document. Subsequent to that being released, the Queensland Under-Treasurers have released their own strategies to move the Queensland departments and stat bodies towards best practice. So the best practice strategies required are very clear. And this year we will be making an assessment of how well you're going against them as part of our audit. So on a monthly basis, all key account balances should be reconciled. We're looking for meaningful variance analysis with red flags highlighted. So if there are changes to your business environment, we need to know how this will assess your financial statement preparation process. Any emerging issues need to be discussed with us and brought to the attention of the audit committees. The level and complexity of the commitments and contingencies note will vary from one department to another. Some departments may have very little change in their reporting on a month-to-month basis. However, all departments need to consider their exposure to legal liability and the potential events after balance date. When you do come up with exposures and risks, they need to be mapped again to financial risk and then to the financial statement balances. And I'd expect this to be reported at an audit committee level as well. Now, most departments are adopting at the moment some form of soft close. The term soft close describes a partially ready audit process at year end. So if we pick, say, 31 March as an example, when we come in to audit your 31 March balances, we would expect to see your key account balances have been reconciled, all your fair value assessments have been made, and that pro forma financial statements have been rolled over to the next year, and all the disclosures have been reviewed and updated to capture the current accounting standards. Hard close down here is much harder to achieve, and it will often require a large investment in resources and technology. It's basically adopting a year-end process for every month end. So a hard close means that a month-end trial balance is audit ready, and with the flick of a button could be pre-populated into a set of audit-ready financial statements. So I'm not quite sure if it has a huge benefit to government departments. It's very commonly used within multinationals where they have various year ends for reporting requirements right around the world, and very risk-adverse boards, complex regulatory requirements. They need to know every month end that they have a perfect month year-end close position, because they could be reporting anywhere at the world on 31 March, 30 June, 31 December, 30 April. However, there are some aspects of it that could be adopted to improve your month-end processes. So early close has the benefit of identifying the emerging accounting and auditing issues. It goes on with the no surprises approach that we want to adopt, and this goes both ways. So it's up to us to bring to your attention any emerging audit issues, and that will be where we've found something that we can't audit because there's simply not enough audit evidence, and then you still have a couple of months to go away and gather that evidence for us. But equally, we need to be able to engage with you as soon as possible on the one-off, the complex, the significant transactions and changes in accounting policy that affect your department. If those transactions have whole of government impact, we'd encourage you to seek advice from Treasury, and we'll be looking for that as part of the audit process. So now that your year end has been dealt with, we need to consider events that occur after balance date. And if any significant decision or event occurs between the 1st of July or the 31st of August, we need to know about it. And we do need to know about it with sufficient detail to be able to understand if it impacts your financial statement balances. So we'll be looking for confirmation that the most senior executives have disclosed both to the CFO and to us any transactions that will impact the financial statement balances or disclosures. We realise that some of this information is very sensitive and commercially in confidence, and we will be respecting that confidentiality. But we also need executive management to respect that there's an accounting standard on this and it needs to be adhered to. So we've spoken a lot in previous sessions about the application of AASB 13. Non-current assets usually represents quite a significant portion of the balance sheet and the financial statements, so we do spend a lot of our audit effort on it. We'll be auditing for compliance against the accounting standard and the NCAPs, or at least your preparation towards that compliance. It's the first year it's going to be adopted. we're not going to come down and request changes unless it's a material impact. We will work with you to make sure that even for the next year that you're meeting the standards. But do expect some management letter points if you're not meeting the standards. We'll be bringing to the attention of the audit committees what's not happening. We do expect the valuations, either internal or independent, to be performed at least by March or April, and that's in line with the Under-Treasurer's guidelines. It's certainly permissible to get those valuations done much earlier than that and just do a summary to make sure that there's no significant changes or volatility in those underlying assumptions. And as we've said several times in our talk already this morning, independent valuations aren't required every year. They're only required every 5 years under the accounting standards. And in the meantime, all you have to do is prove to us that there's no significant volatility or change in the underlying assumptions. And what we'll be auditing there, so when a class of assets has been revalued, we will need to see some audit evidence about the valuation process to make sure that the scope of the valuation and the key assumptions and inputs that the valuer has used is in line with what should be there and what is reasonable. One of the things I always look for is, do they make economic sense? Particularly in local government where asset valuations can change dramatically from year to year, there's really no economic basis for it. The difference is just a different valuer has done it this time and used a different methodology. So we'll certainly be looking at that more in the future.